Hi there, welcome to Neppy Invest and welcome to part 9 of 3 small cap stocks to watch on the ASX. Now, this video series was inspired by the Appendix 4C season we had or finished in January, but since then we've also had the half-yearly and yearly reporting season that just finished in February. So a lot of the numbers I'll show you, the operating cash flow and revenue, that sort of thing, will be taken from either the half-yearly or the Appendix 4C. Now, the whole point of doing this video is to share ideas. So hopefully, at least one person who watches this video will get some inspiration to do some more research in one of these companies I'll show you, and then even potentially become a shareholder. So let's get to the agenda of the video, and the 3 companies I'll be focusing on are Tinybeans, that's not a coffee company, Limeade, and that's not a lemonade alternative, and Damstra is not a swear word. So I'll be focusing or looking at 4 different slides for each company. The first slide, I'll be looking at the fact sheet and the financials. The second slide, I'll be looking at the operational cash flow of each company. And the third one is looking at the cash receipts history. So I do like to see or look at the trend of cash receipts, and I like that to be an uptrend, obviously. And finally, I'll be looking at the chart and seeing what the share price has been doing over the past 6 months or year. So the first company I'll be looking at is Tinybeans. This is the sort of company you might use if you're a parent and you want a safe and secure environment to share the photos of your children to relatives and friends. That's the thing they sort of do, is a platform that parents are able to share the photos and memories of their children. Anyway, so this company has a market cap of $70 million, revenue in the trailing 12 months of $9.1 million, and operational cash flow negative by $2.6 million. If you do want to do some more research on this company, I do highly recommend that. You can have a look at their Appendix 4C, which was released on the 21st of January, or their half-yearly report, which was released on the 25th of February. Now, this is the operating cash flow from the most recent Appendix 4C. So I want to look at this because when I looked at the half-yearly report, they were still negative cash flow in operations, but the most recent Appendix 4C looks like they might have reached an inflection point because they were operational cash flow positive in the most recent quarter. Only $96,000, but it's a start. And that's always a good sign when a company gets to this point where they're operational cash flow positive. It typically means there is that potential that they won't have to do any more capital raisings, won't have to borrow any money from a bank at astronomical interest rates, and only potential because they might do an acquisition, which means they might have to raise capital, but they are heading in that direction. You can see that by the beginning and end cash for the quarter. They began the quarter with $4.6 million and finished the quarter with 4.5. So they are not bleeding cash, and that's usually a good thing. The second most important thing, and this is something I really like to see, is a really good uptrend in the cash receipts over time. So they began on the ASX. This is not an Australian company, I believe. I could be completely mistaken. I think it's an American company. Anyway, they listed on the ASX in early 2017. In the first quarter, they only had $240,000 in cash receipts, and they've built that over time. And the most recent quarter, it's 3.2. Not only that, the growth rate in cash receipts is increasing. You can see that when I've calculated the compound quarterly growth rate since they listed, which is 18.8%. Then I looked at certain time frames. So over the last 10 quarters, they've been growing at 19%, last 5 quarters growing at 24%, and the last 3 quarters growing at 35%. And it seems like they've really taken off in this last quarter for some reason. Now let's look at the chart for Tinybeans. This is looking at the 1-year daily chart, and a lot has happened in the past year. So in about 2 months of time, we won't be able to show you the COVID-19 financial panic because this time last year, a lot of people were panicking as they were watching shares and companies they own go down like, not like a rocket, because rockets are supposed to go up, but going down like a rocket that has completely failed, which is you never want to see that. But anyway, the share price and sentiment turnaround in Tinybeans happened around August or September last year. And you can see that in the change in the moving averages. Instead of going down and the share price was below the moving averages, share price got above the moving averages and the moving averages started to turn. That's usually a good sign. Usually that signifies a change in share price trend and sentiment. And we've definitely seen that with Tinybeans. Currently, the share price is $1.62, quite a bit higher than the lows we saw a year ago when it got down to 60 cents. The other thing I like to see is an increasing in volume, and there's a very subtle increase in volume over the past year. It's usually a good sign, and it can be an indication that fund managers are becoming interested in this company, and maybe they're becoming interested in this company because this was the first quarter that they're operational cash flow positive, and that's usually a good thing. So the next company I want to look at is Limeade. This is an employee experience software company. So if any of my managers are watching this, maybe you can hire Limeade to increase my experience at work. Now, this is almost certainly an American company or American-based company. And unlike Tinybeans, which I was a little bit unsure, I'm almost 100% certain this is. And the main giveaway is they do report in American dollars. So all the numbers I'm going to show you, or financial numbers, are in American dollars. But anyway, the main reason I wanted to look at Limeade is the shenanigans that have been happening with the share price ever since they released their full-year numbers on the 26th of February 2021. In fact, the day after they released their financial report, the share price fell 30%, which I found quite interesting. Anyway, their financial numbers didn't look that bad. So revenue 56.6 million and operational cash flow positive 3.8 million. But hint, hint, it's not the numbers that the market was, well, concerned about. It was the outlook that management gave, and I'll get into that in a few slides. So when looking at the operational cash flow, I want to focus on the Appendix 4C that they released at the end of January instead of looking at the full year numbers, because there are some interesting things here that you can glean from it. Now, the first thing is that really drew me in was instead of being operational cash flow positive like they were through the whole year, they had become operational cash flow negative to the tune of 1.5 million. The other interesting thing that caught my eye here was the receipts from customers. They reported as $80.7 million in the Appendix 4C, but in the financial report, they only reported that as $56.6 million. So you can see a very big difference between the receipts from customers and the revenue. So receipts from customers typically is actually less than revenue for a growing company, but in this case, it was actually more, which I found really interesting. And the receipts for customers in this quarter was only 14.3 million. Now, they don't have any problems with cash moving forward because they still have $31.5 million of cash at the end of the quarter or the end of the financial year. The other interesting thing is the trend in receipts over the past 5 quarters. So they listed on the ASX at the end of 2019. So we only have 5 quarters of history here, but it's not looking good for Limeade. In fact, the cash receipts are going backwards. It is a small sample size, but this is not the sort of thing you want to see for a company that's supposed to be growing. In fact, the most recent quarter, the cash receipts was the lowest through their life on the ASX. And if you look at the compound quarterly growth rate, it's actually negative 7%. So not looking good for Limeade when you look at the receipts history over the past 5 quarters. Now, looking at the 1-year daily chart, we do have just over a year of history here, and it's not looking good over the past week or so. So the share price was around $1.50 to $1.60 only a week ago, and then when they released their financial report, the share price didn't drop initially. It was around about $1.50, and then the day after they released the report, the share price dropped 30%. You can see that big red down day on really high volume, and the share price is still dropping. So on that day it finished at $1 and now it's closed at 97 cents. So it's not looking good for Limeade right now when you just look at the chart. So why has the Limeade share price dropped? And usually when a company share price drops after they release a financial report, it's usually because the results either beat or miss guidance, or the outlook is really positive or really negative. And in Limeade's case, their financial year 21 guidance was actually less than what we saw in financial year 20. Revenue 50 to 53 million and negative EBITDA and NPAT. And I think the market saw that the day after they released the report, and that's why we saw a lot of selling. And finally, I want to have a look at Damstra. So Damstra is an interesting company for two reasons, and there's one main reason I really want to look at this company. But before I get to that, this company is a software as a service company, and what they do is they help industries and companies comply with health and safety issues. So just think of mining companies where health and safety is a primary issue they have to face on a daily basis. So Damstra helps with those companies. Now, the main reason I wanted to look at Damstra is because what's been happening with the share price over the last 3 or 4 months. Now, about 3 or 4 months ago, this investing service recommended Damstra to their clients, and this recommending site, or this investing service site, is very popular. You can always tell when they recommend a company to their clients because the share price always pops up quite suddenly right on midday. And with Damstra, it did that. It went from $2 to about $2.30 in like a minute or so. And then ever since then, the share price has just kept on dropping, and it's gone from $2.30 all the way down to below 99 cents. I think today, on the 3rd of March, it did drop below $1. So the more the share price falls, the more interested I become in Damstra, even though it is a tech company. And the economic environment we could be facing in the next few years, next 5 years or so, with potentially increasing interest rates, increasing inflation, that would be quite bad for tech companies, because that's not the sort of environment that tech companies would flourish. But in saying that, I still would be interested in this company if the share price keeps on dropping, and I'd just be waiting for a turnaround in the sentiment and the share price before I bought in. And particularly when you look at some of the financial numbers in the trailing 12 months, revenue of 32 million and operational cash flow positive by 6, this is an attractive company. So what I'm looking now, instead of the cash flow from the Appendix 4C, this is that cash flow statement straight from the half-yearly report they released at the end of February. I do like this statement, the way it's set out, because you can see all the cash flows from operating, investing and financing in the one statement, unlike the Appendix 4C, where it's already released over about 3 or 4 pages. And you can just look at a lot of things that's happening, where the cash is coming from and where the cash is being bled out from. And in Damstra's situation, we do have cash flow coming in operations, 2.6 million, but they are bleeding cash in investing and financing activities. And because the cash they're bleeding out in those two sort of activities is more than operations, they are losing cash. And in fact, from the start of the half year, they began with $9.4 million in cash and finished the half year with $7.6 million. And the main reason is because of capital expenditure, which is $1.4 million, repayment of lease liabilities, $1.6 million, and intangibles, which whatever that is, goodwill or something, $2.3 million. They even borrowed $1 million, and with that $1 million of borrowings, they were still cash flow negative throughout the company. So just like Limeade, Damstra hasn't been on the ASX that long, so we only have 5 quarters of history here. And one thing it does have over Limeade, we do see the receipts growing over the last 5 quarters. It's gone from 4.6 million to 7.4 million. It is, or does seem to be a little bit lumpy there, but it's growing at 12.6% per quarter. So at least that's one thing this company has over Limeade. Now to the 1-year daily chart for Damstra, and this is a thing of beauty in my opinion. You might completely disagree, particularly if you are a shareholder of Damstra and you bought in at $2.40 in October. But the couple of things I do take from this, the first thing I take is the volume, and the real big increase in volume around May of last year. So it was not a lot of traded in this company from when they IPO'd in late 2019 to about May. And then when the share price trend changed and the sentiment around this company became more positive, we saw that volume really pick up, and that drove the share price from about 90 cents all the way up to $2.40 by the start of October. And funnily enough, the start of October is when that investing service recommended Damstra to their clients. The share price went from $1.80 to $2.40 in a few days. And then ever since then, the share price has been dropping, and it's gone from $2.40. And then today, On the 3rd of March, it has fallen below $1. The last 4 trading days, the share price has just come under attack. I'm not sure what's happening. Maybe the market just hasn't liked their half-yearly report they released to the market. But at this point in time, there's no point buying. This is just my opinion, because I can just imagine there are people out there saying, oh, this is really good value. It's at $1. And there would have been some people saying at $1.50, it's exactly the same thing. Even at $2, there would have been people saying this is really good value. Now, it was $2.40 a few weeks ago. Now it's $2. This is really good value. I'm going to buy in. In my opinion, just wait. Get some confirmation of a shift in sentiment, shift in the share price trend, and that's when you buy in. You don't catch a falling knife, and this is a perfect don't catch a falling knife scenario. Now, maybe this is going to be the low, but until you get confirmation that this is the low, I wouldn't be buying in this company at all, even if I'm interested in the company. And that's all for this video. Hope you've enjoyed it. Hope you've learned something. Hope you've been inspired to do more research on one of these companies and potentially buy in down the road. Otherwise, I'm not a financial advisor, so even though you might be thinking I'm giving you some financial advice, I'm not. I'm just doing this for educational, entertainment, and research purposes. If you do need some financial advice for your own circumstances, make sure you seek out someone who is qualified and can speak to your own financial needs. That's all for this video. Have a good day. Bye.